all about calculating your development loan. This is actually something that I found myself speaking to clients more and more over the last sort of 6 months or so, as some of our existing clients start venturing into development. And certainly we're getting a lot more inquiries where this type of finance is the perfect product. So first of all, it's very important to understand that development finance is actually part of the bridging family. It's short-term funding, and it's only meant for a short-term purpose, which means there's a lot of overlap in the type of criteria and even the lenders that offer this type of finance, as well as your more standard bridging loan. And what development finance does is it allows you to borrow against the purchase price, which we would sort of split over as the bridging element, and also cover the cost of the works, which is our development part of the loan. Here we go. It's almost like I wrote this myself, isn't it? Split the loan into, we split this loan into those two. The bridge, which is typically up to about 70% of the purchase price maxed out. There are some lenders that will go a bit higher, 75, but typically maxed out at 70% of the purchase. So this is what we would call sort of our initial advance, the bridging loan against the purchase price. And this is what is released to you on completion to contribute towards the purchase of the property. The next section is the development facility. And this can cover up to 100% of the cost of the works. Now, it's very important to understand with this that the tranches of funding that we organise through a development finance facility will be drawn down in arrears, which basically means that if you had £100,000 worth of work, for example, and there were 4 tranches and they were £25,000 each, you would need to pay for the first £25,000. The monitoring surveyor would come out and have a look at what was going on, make sure that you're on track, and then they would give the rubber stamp for the lender to allow you to draw down 25. So you pay out 25, you then get the 25 back, you use that for the next and the next and the next. So eventually you do get 100%, but you need to kickstart things with the first tranche, essentially. So when I was talking about the loan to GDV, the whole loan, it cannot exceed more than 70% of the GDV. So again, if the GDV, just to keep things simple, was £1 million, the total loan facility, including both of those sections, cannot exceed more than £700,000, because that's 70% of the GDV. Now, different people work it out in different ways. The way I like to look at it is, let's cover the development facility first. And there's a very, very good reason why I say this is a good idea, because you only start paying the interest once you draw down the loan. So if you cover the cost of the development facility first, and say, for example, you said, oh, well, I want to borrow as much as I can day one, but I'm going to put in X amount into the cost of the works. Why not put that money into the day one purchase and push back the date that you have to start paying interest on the bulk of the funding? So we start with the development facility first. And how we break this down is the development facility will be made up of enough money to cover the cost of the works, a 10% contingency typically, 10 months worth of interest on average. If we're looking at an 18-month term, the lender will work out around 10 months worth of interest, because this is usually more than enough when you work out when you're going to start actually paying interest on potentially 3 or 4 tranches of funding. Overall, roughly what it's going to equate to. It will probably come in slightly less than that, but they would much rather you be covered, hence the 10% contingency as well, to cover all eventualities. Now, they'll also cover the cost of the monitoring surveyor visits, because what they don't want is for you to need to draw down the funds but can't afford to pay for a monitoring surveyor to come and look at the property. Typically speaking, you're looking somewhere between £500 and £1,000 per visit. So split the difference, probably need about £750 per visit, which they will incorporate into the development finance facility. So once we've got that, though, all of those elements covered, whatever remains can contribute towards the purchase. However, again, number one, it can't go above 70% of the purchase price, and it can't obviously go above 70% of the GDV in its entirety. To get better lending when it comes to development finance, very, very simply put, you borrow less. There are a lot of clients out there that I speak to from a development finance point of view who get a little bit disappointed when it comes to the types of terms that they're offered, but it's because they're maxing out on the loan to value and on the loan to GDV. They want to cover 100% of costs. They want 70, 75% day one. If you can get your loan down to, say, 50% day one and 100% of your costs, you're going to see a big difference. Experience also plays a massive role in the type of finance that you're going to be offered from various different lenders on this base as well. So that is that is as literally as brief as I could make it on how we work out development finance.